today. I want to go on right on to our next segment, wrap the week. So every Friday, we like to take a look at how this week's activity has affected the long-term charts, try to make sense of things. We want to start with a poll. So we always have polls running on the StockCharts TV page on our website. Also on our YouTube channel, we'll circulate some polls. So make sure you subscribe there and you'll get all the notifications. We asked you what will happen before the end of this year. Option one, the S&P 500 breaks above the February high around 3,400. Option two, the S&P 500 breaks below the March low around 2,200. Option three, neither will happen before the end of the year. And the number one answer was the last one. Although, to be honest, there wasn't a huge spread between these three. There wasn't a clear outlier, but the number one, the most popular answer was neither will happen. Essentially, we'll be range bound between the February high and the March low. And looking at the chart, that's, I mean, a pretty decent case. I put a video on my YouTube channel today about the three directions of the market. The market can go up, it can go down, it can go sideways. That's this poll question actually inspired that video. And I see your point, 40% of you that say this is a huge range now, and you could see us spending some time sort of filling in this range. And even Craig Johnson from Piper Jaffray on the show this week, who is very bullish, expecting the S&P to reach 3,600 by year end. Still expected more of a sideways trend for a little bit before we would resume the uptrend. So I think that's justifiable. A third of you, though, suggesting we will break above the February high before the end of the year, and 27% of you, 1 in 4, just over that, expect us to break to new lows. So what's interesting about how you responded is there's a pretty wide spread. There's a decent, meaningful amount of you on each of those three different responses. So we will have to see which one of these, how things play out. I wish I could tell you what the right answer is going to be. All I can do is show you the charts and try to answer them with you together. Having said that, let's continue our process of wrapping the week by looking at the Mindful Investor live chart list. We do this every week. It's also part of my weekend routine. If you've not looked at this before, it's no problem. Click on the articles page on StockCharts on the right. You'll see all StockCharts blogs. Go to my homepage here, which is the Mindful Investor, and then you'll see live chart list at the top. That'll take you right to this thing, and you can actually access it at any point. I customize, I tweak it over time, but usually relatively stable list of charts. So we're going to start with sort of my long-term market trend model, and this combines three time frames. The PPO, the weekly PPO based on long-term moving averages, the 21 and 34-week exponential moving averages is number one. And if that's above zero, it's bullish. Below zero, it's bearish. It turned bearish in mid-March, remains that way. And again, that's part of the reason why I've talked about a bear market rally a number of times, is because of that remaining in a position of negative trend. The medium trend for me is looking at the weekly PPO using the traditional 12 and 26 week read, and then a 9-week signal, which is the red line here. That turned negative mid-February, has remained negative. Although the rally in the last month has certainly pushed this closer and closer to a buy signal, has not happened yet. So it remains on that medium trend, being weaker rather than stronger. The short term, the tactical trend for me is looking at the change in the histogram of the MACD. You can see that turned positive here at the end of March and has remained positive, sort of matching this short-term uptrend. So again, for me, it's less of a predictive model in general. It's more of establishing where we're at and making sure I start my process with a good long-term, medium-term, short-term perspective. So for my read, it's still long-term bearish, medium-term bearish, short-term bullish, and that's about how the market has felt to me looking at the chart subjectively. Looking at the daily chart, again, we talked about this earlier in our market recap. I think what's key is we've reached that 61.8% level. We are right below the 200-day moving average, which has been relatively flat around 3,000. So I think at this point, most people feel validated. I've talked about a bear market rally. I feel pretty good about this being a potential ending point for it. If we would break above 3,000, I would have to completely turn on that and say we're going to go to previous highs, if not further, because that's enough momentum. But at this point, I'm seeing the market fail at resistance with an RSI that did not get above 60, and that is characteristic of a bear market, the end of a bear market rally, to be honest. Now, on that short-term tactical time frame, our next chart is looking at the cumulative advanced decline lines on the S&P, the NYSE, the New York Stock Exchange, the mid-cap universe, and the small-cap universe. You can see all four of those making higher highs and higher lows along with the market. So as long as that pattern continues, I think you have to feel pretty good about a continued short-term, that tactical time frame, the short-term time frame, couple days to a couple weeks continues to be positive. If we start to get lower lows, lower highs in that in those readings. And this is not updated quite yet for today. We'll have to see how far it goes down. We start to get these breaking through the swing low from a week and a half ago. I think that'll be pretty telling. This chart, new highs and new lows, often looks a lot more interesting. It really hasn't been because it's been so flat. So many stocks, just like the market, are in a huge range from their 52-week high and 52-week low. So besides that handful of names making new highs and that handful of stocks near their lows, pretty much everything is mid-range. And so this is really flattened out, remains that way. If you would start to see in a sustained uptrend, we started to see more and more S&P names making new highs. That's sort of come off a little bit of things have retraced back into that range. So looking for that to increase would certainly validate more of a bullish thesis. In one of the ultimate bonehead strategist mistakes, I tweeted out an outdated chart of this next one, and I feel horrible about it. It was definitely not intentional, but hopefully a reminder to myself and others that I am imperfect, which I don't need reminding of that too often. But if you look at what has happened, over 70%, almost 76, 77, 8%, something like that, of the S&P 500 in about a month have gone from no stocks above their 50-day to almost 80% of the S&P above their 50-day. That was in 3 to 4 weeks, which is huge, right? That's a huge swing, and it's an unprecedented swing, but not completely unprecedented. And again, thinking of how this fits into previous sell-offs. If you look at late 2008, you had that same sort of sell-off, then rally with 0 up to 80%, and that's a lot like what we've seen right here. And so looking at that in particular, it's starting to look a little bit more like late 2008. The number of stocks above their 200-day was totally different, though, because stocks had been in a downtrend, remember. So 2007 to 2008 was a downtrend of almost a year before you had the big sell-off. This has been very different. We came right off of the highs and rotated lower. So it doesn't have a perfect historical precedent, but an interesting one. I've had a lot of questions about the AAII rankings, the sentiment rankings from the American Association of Individual Investors. I would remind you all, it's a piece of anecdotal evidence that I use. I've not found it to be statistically meaningful if you look at all of the indications. But for me, there's value in looking at survey data, just like there's value in looking at investment themes that pop up on major publications. We used to use Time Magazine and things like that. But now, looking at The Economist and seeing what sort of themes come out there, because that usually plays off the underlying sentiment. That's where the masses are positioned. And the AAII ratings, with all of their faults, I think still have some interest to me, some intellectual interest, looking at how those sentiment readings have changed. And it's worth noting, we were at an extreme negative signal last week with 50% of respondents bearish. That's come back up to 44, and you've seen an increase in bullish respondents. So from last week to this week, you had a huge distribution, a huge negative swing that's now kind of come back to mid-range. So for me, that volatility in the voting suggests sort of the volatility that we've seen in terms of the uncertainty that we've seen in the markets as a whole.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.